In 1792, a group of 24 savvy investors and brokers gathered under a buttonwood tree on Wall Street to sign an agreement that would form the New York Stock Exchange. This gave birth to one of the most important financial institutions in the world, the start of the U.S. stock market. Over the past 2 centuries, the U.S. stock market has weathered countless storms, from the highs of the Roaring '20s to the lows of the Great Depression, from the dot-com boom to the 2008 financial crisis. The U.S. stock market has proven to be one of the most fascinating and unpredictable forces in the world of finance. So buckle up and get ready for a wild ride through history. But before we dive in, make sure you hit that like and subscribe button to support our work. As you all know that the U.S. stock market's foundation started under a tree. Pretty cool. But the Philadelphia Stock Exchange actually beat the NYSE to the punch as the first stock exchange in America. Established in 1790, it played a crucial role in shaping the country's economy. Fast forward to the 1970s, a new player joined the party, the National Association of Securities Dealers Automated Quotations, or NASDAQ. Unlike the NYSE, the NASDAQ allowed investors to buy and sell stocks on a network of computers, making it a revolutionary addition to the stock market scene. And in 1992, the NASDAQ teamed up with the International Stock Exchange based in London, creating the world's first intercontinental securities market. Well, the stock market can be as confusing as trying to explain quantum physics to a toddler. So let's put that discussion on hold for now and focus on something more entertaining: how the market has fared during some of the most turbulent global events in history. Starting with the Roaring '20s, the U.S. was at the peak of the Industrial Revolution. When the Europeans were busy in useless wars, the U.S. was focusing on reaping the benefits of capitalism, and fashion and pop culture contributed to economic uplifting. During the 1920s, the U.S. stock market experienced a significant period of growth and prosperity, with the Dow Jones Industrial Average increasing by over 500% from 1920 to 1929. But then the dark clouds came over the horizon. During the Great Depression, the U.S. stock market lost approximately 90% of its value. The market crash began in 1929 and lasted until 1932. At the start of the Great Depression in 1929, the Dow Jones Industrial Average, or the DJIA, stood at around 381 points. By 1932, it had fallen to a low of just 41 points, representing an overall loss of 89%. The market didn't fully recover until the mid-1950s, nearly 2 decades after the crash. Then came the devastating Second World War, which once again tested the stock market. Obviously, the US took part in the conflict, which had a direct bearing on the economy. Dow Jones Industrial Average dropped by more than 40% from its pre-war peak in 1937. Another major event that came to the forefront was the Cold War, and the US's first strategy was to pour economic aid into friendly countries. The Marshall Plan, which was a US program providing aid to Western Europe following World War II, had a positive impact on the US stock market. The plan helped to stimulate economic growth in Europe, which increased demand for US goods and services, leading to increased profits for US companies. This resulted in a bullish market from 1948 to 1949, with the Dow Jones Industrial Average increasing by 50% during that time. The next big challenge came in the form of the Suez Canal crisis. In July 1956, Egyptian President Gamal Abdel Nasser nationalized the Suez Canal, which was previously owned by French and British interests. The crisis caused a spike in oil prices as the Suez Canal was a crucial route for oil shipments between the Middle East and Europe. The U.S. stock market initially reacted negatively to the crisis, with the DJIA losing almost 7% of its value in the first week of trading after the canal was nationalized. However, the market eventually rebounded, with the DJIA ending the year up over 2%. Interestingly, the stock market has also heard the nuclear alarm bells. In October 1962, tensions between the United States and the Soviet Union were at an all-time high. President John F. Kennedy ordered a naval blockade of Cuba in response to the discovery of Soviet missile installations on the island. The stock market reacted immediately, with the DJIA dropping over 10% in just 5 days. Investors were fearful of the possibility of a nuclear war, and many sold off their shares to protect their assets. Fortunately, the crisis was resolved peacefully, with the Soviet Union agreeing to dismantle their missile sites in exchange for a U.S. pledge not to invade Cuba. The stock market quickly recovered, and the DJIA returned to pre-crisis levels within a few weeks. The next big thing of that decade was the Vietnam War, which made the stock market quite volatile, with DJIA fluctuating between a low of 631 points in May 1962 and a high of 1,051 points in January 1973. And while Vietnam War was already hampering the global economy when the global oil crisis happened. The 1970s oil crisis was triggered by a decision by several Middle Eastern countries to embargo oil exports to countries that supported Israel in the Yom Kippur War. The S&P 500 index experienced significant volatility. Initially, the index declined sharply, falling by around 43% between January 1973 and December 1974. However, things went on track when the crisis was de-escalated. And for your info, after this crisis, OPEC was created to regulate the global oil demand and supply. Elsewhere, on a fine morning on October 19, 1987, there was chaos on the market. Known as Black Monday, it was a pretty big deal because the Dow Jones Industrial Average fell by a whopping 22.6%, and the S&P 500 index dropped by 20.4%. The crash happened because of a bunch of factors, including high interest rates and overpriced stocks. It caused a recession in many countries. But quite possibly the end of the Cold War heralded a new dawn in American life. It was the start of rapid globalization and the tech bubble. In the late 1990s, the US stock market experienced a surge of growth fueled by the rise of the internet and technology companies like Google, Intel, and Microsoft. The NASDAQ Composite Index, which is heavily weighted towards tech stocks, increased by over 400% between 1995 and 2000. Conversely, the tech boom bubble burst following the dot-com crisis, and the NASDAQ index, which was heavily weighted towards technology companies, fell by over 70% from its peak in March 2000 to its low in October 2002. But the decade of development was followed by the horrors of terror. 9/11 shook the world and the stock market too. The Dow Jones Industrial Average fell by over 7% in the first week of trading following the attacks, and the S&P 500 index experienced its biggest weekly decline in over a decade. The insurance and airline companies were in the doldrums, and national security came in, which impacted the American tourism industry. However, the chaos turned into calm some years later. Later, it was again reignited by another global crisis. This time, the global economic recession thanks to the 2008 housing bubble. This time, Wall Street crashed and made the global economy to a standstill. The S&P 500 fell by over 50% from its peak in October 2007 to its low in March 2009, and this was one of the most significant declines in US stock market history. Some scholars assert that it took the world 2014 to come to the pre-2008 growth levels. Whew, that was one hell of a ride. The US stock market once again started to see growth post-2014, owing to the rise of big tech companies and the dominance of Silicon Valley. To add to that, the social media boom stabilized the economy, created job opportunities, and made a more digital world. Parallelly, Brexit happened, which gave a shock, and on that day, the Dow Jones Industrial Average fell by over 600 points, making one of the largest single-day declines in its history. The US companies working in Britain went into significant losses, which was a worrying sign. But perhaps the biggest of the lot was the virus, which completely changed our lives. Little did the virus in China know that it was about to disrupt the global economy. The supply chains were dismantled, and it was chaos everywhere. In early 2020, as the severity of the pandemic became apparent, the stock market experienced a sharp decline. The Dow Jones Industrial Average and S&P 500 both experienced their fastest ever declines into bear market territory in February and March of 2020, as investors reacted to the uncertainty and potential economic impact of the pandemic. And now the war in Ukraine has once again put the world in topsy-turvy. When Russia invaded Ukraine on the 22nd of February 2022, the S&P 500 fell 1.8% to 4,225.5, closing nearly 12% from its January 3rd record close as it slid deeper into a correction. The Dow Jones Industrial Average dropped 464.85 points to 33,131.76, and the NASDAQ Composite lost 2.6% to 13,037.49. Even still, if we look at the numbers, sanctions on Russia have impacted the US stock markets. If we analyze closely, since the 1920s, the stock market has seen so many ups and downs. Indeed, the history of the stock market has been marked by numerous ups and downs, from the Roaring '20s to the Great Depression, from the dot-com bubble to the global financial crisis and the COVID-19 pandemic. These events have had a significant impact on the global economy and the financial markets, and have left lasting effects on investors and businesses. While the stock market can be volatile and unpredictable, it is also a powerful tool for wealth creation and economic growth. Despite the challenges and uncertainties, the stock market remains a vital component of the global economy, providing opportunities for investors to participate in the growth of businesses and economies around the world. If you like our content, do subscribe to the channel, and do let us know your thoughts on the history of the US stock market in the comments.